Good morning, Guy Wagner.
Good morning.
Before we talk about perspectives, let's take a quick look back over the last year. How would you sum up 2024?
I would say it was a good year for the equity markets, especially obviously for the US market. It was a decent year for the economy. Growth was positive, but not very strong. Inflation, after having come back quite a bit, stabilized around this 3%. And what's interesting is even though inflation remains above these 2% targets that the central banks have, in spite of that, they started to cut their interest rates, which tends to show that this 2% objective is no longer really relevant.
A lot has happened in the world since we last spoke, not least Donald Trump's return to the White House. To what extent will this disrupt the global macroeconomic situation?
I think it's very difficult right now to make predictions about that because we don't necessarily know what will really be the priorities of the administration. Some of them seem a little bit contradictory. So from that point of view, and we've seen that recently this week with tariffs were announced and they were delayed, etc. So right now it's really very, very difficult to make predictions about what that will in the end really mean for the world economy.
Increasing number of countries are facing spiralling public deficits. Could this threaten the global economic balance?
Yeah, I think it's a huge problem, a little bit like for ourselves. If we have a lot of debt, we become fragile. And now we have a lot of public debt, we have a lot of private debt, but especially the public debt levels are very high. And we see that in most countries, we also have quite high budget deficits, which basically means that debt will continue to increase, and sooner or later there will be a problem because on that debt you have to pay interest. So the cost of the servicing that debt becomes higher and higher, and then sooner or later there will also be the question of who will buy all this debt, and so that makes the world economy quite fragile.
Inflation continues to be a key economic variable. How do you see it evolving in the short to medium term?
I think especially in the medium or longer term, we see an environment where inflation will be structurally higher. What I mean by that is we were used over the past years that we had low and stable inflation somewhere between 0 and 2%. And I think going forward, there are a lot of trends that should point towards structurally higher inflation. What I mean by that is not that we necessarily always really have very high inflation, but that whereas in the past you could say 2% is more the peak level, now it will be act more as something like a floor. And I think, again, inflation will be structurally higher and more volatile.
In the latest edition of Perspectives, you point out that China wants to set up an alternative to the historical financial system based on the dollar and US government bonds. It has already launched several initiatives along these lines, for example, signing trade agreements allowing transactions in renminbi with a number of partners. Is this merely a side issue, or is it an early indication of a sea change in the established order?
I think it's a sea change, it's a secular trend, and it's only at its beginnings. I think China and a lot of countries desperately want to get out of this dependency vis-à-vis the dollar, and that's clearly what we're seeing.
In Europe, do you see the very unstable political and economic situation, particularly in Germany and France, as a threat to the overall health of the Eurozone?
Yeah, I even see it as a potential threat for the euro itself, in the sense that we have now the two biggest countries in the eurozone which have problems which are a little bit different. Germany has more of an economic problem, France has a debt problem, and from that point of view it will be interesting to see how that will be solved. Maybe we'll go towards this idea of fiscal union, and which we still don't have. Otherwise there might be a problem for the euro itself.
And you mentioned that since the turn of the century, in other words, in less than 25 years, the euro and the dollar have lost around 50% of their value in terms of purchasing power. Do you expect this trend to continue?
Yes, clearly this idea of debasement of paper currencies will clearly continue. It's linked to everything we said before, the high debt levels, budget deficits, etc. And basically we see that the supply of paper money can easily be increased. On the other hand, the supply of a lot of other things can't be increased that simply, and so by definition one loses value against the other, and I think that's clearly the trend. And we've seen that even for the dollar, since it's no longer convertible in gold, I think some 50 years ago, it has lost some 95% of its purchasing power. So clearly this idea of debasement of paper currencies is a very important theme. that people should be aware of, because it directly influences their purchasing power.
And then we come to equities, which are still an attractive investment vehicle. But what type of equities should investors be focusing on?
Yeah, equities are an attractive investment vehicle because, to a certain degree, they allow you to protect yourself against the debasement of the paper currency. So, as such, being real assets as opposed to monetary assets, equities clearly should be preferred to bonds. But then you have the question of which equities to buy, and we clearly nowadays in a market which is dominated by passive investing, by speculation, which means that the market is driven by, the world market is already driven mainly by the US market, which itself is mainly driven by a handful of companies. So either you play that game with all the risks attached, but that was the right thing to do over the past years, or you try to do something different, which I would call real investing, by choosing companies which are of high quality, but where maybe the valuations are more attractive, with the risk of continuing to underperform.
So, of course, this brings us to the question of management strategy. Which do you prefer, passive or active?
Yeah, for me, it's clearly active in the sense that, and again, I'm often making this point, you have to choose whether you're an investor or speculator. And investor, basically, you try to take a long-term stake in a good company and based on a decent price. As a speculator, you buy a stock with the idea of selling it to someone else at a higher price, but fundamentals are less important. But again, with also this trend towards indexing, we are much more in a world of speculation. And active managers, and we all know that, have tended to underperform quite dramatically over the past years.
Yeah, and you said that the equity market, well, in perspectives, you said accounts for nearly 70% of the world equity market index, which is a record. Is this domination a concern? Yeah. Isn't there a risk of destabilising the economy?
It's clearly a concern. It's a little bit strange. You have the US economy representing some 20% of the world economy, but you have the US equity market representing 70% of the world equity market. Such a situation, we haven't seen such a situation since the late 80s, when Japan back then represented less than 10% of the economy, but the Japanese market was 50% of the world equity market, and that's clearly a concern. But again, it's explained by this trend towards passive investing, indexing, where basically when given that a lot of these indexes are based on market capitalizations, if your stock increases, your market capitalization increases, so your weight in the index increases, so you attract even more money, etc., and vice versa for those which the companies where the stock price goes down. So they tend to continue to go down. And for me, it's a dangerous combination. It has a lot of risks, but for now, as long as the market goes up, nobody sees these risks.
And then you have in Europe, where the financial markets are clearly trading at a discount compared to the US. Would this be a good time to get into European stocks?
Yeah, one must say that the discount of Europe versus US, you can explain it to a certain degree by the composition of the indexes. We have in Europe, we have more utilities, telecoms, banks, car producers, which tend to have a lower valuation than, let's say, the big US technology companies, which makes sense. But still, the discount now is at historically high levels, and you see that a lot of European companies, high-quality companies, are quite a bit cheaper than their US counterparts.
Okay. And let's end, as usual, with a word about gold. It was one of the star performers in 2024. Is it even more of an attractive investment opportunity today, despite its price being at record highs?
Yeah, I think that the long-term outlook for gold is still very good. It has to do with the things we discussed before. It has to do with the idea of China and its allies building up an alternative to this system based on the US dollar. And in this alternative, gold plays an important role, which tends to explain why they buy a lot of gold. And then obviously also gold is kind of a protection against the debasement of paper currencies. So all these trends are still very much valid. Yes, the gold price has gone up a lot, but if you compare it to over the last 30 or 40 years, compared to other economic indicators or house prices or the stock market, then gold is still quite cheap.
Okay. And Guy Wagner, thank you very much for your insights. And to find out more, read issue 182 of Perspectives, which marked its 35th anniversary in 2024.
Thank you very much.